USDA is a fantastic loan if you're looking for zero down payment. And in this video, I'm going to walk you through all of the loan requirements for USDA loans, walk you through all of the ins and outs and nuances to help you decide if this is the right loan for you, and if so, how to apply for one in the best way possible. So the most notable thing about USDA is that it is 0% down. Most other loans tend to be anywhere from 3 to 5% as a down payment, and that's of the purchase price. USDA does not require any down payment at all. And what's nice is this is not down payment assistance. Often people will use something like an FHA loan that requires 3.5% down, and then they'll get down payment assistance on top of it to reduce or remove their down payment. The problem here is normally the rate is increased or there's other terms with that down payment assistance. USDA does not operate like that, and it is just strictly 0% down. Now, there are two main different types. There's direct and there is guaranteed. In this video, we are only talking about USDA guaranteed. USDA Direct is only offered directly through USDA, and it's for low income borrowers. The guaranteed program is aimed to serve low to moderate income, and I'll explain the income limits here in a future slide. And that's what we're going to be talking about here. Guaranteed can be offered by multiple lenders across the country, and then it's going to be secured by USDA. Now, USDA only insures what they call rural areas, and generally this is an area with less than 35,000 people. And I'll walk you through an interactive map so you can see what areas you want to look in. Now, most people can extend their commute around 15 minutes and be in a USDA eligible area. And I put comment, but it's supposed to be commute if it's extended slightly. Also, you do not have to be a first-time homebuyer, and there are options for a one-time close construction loan where you can buy land and then also finance the construction of a home with a one-time close USDA loan. However, these can be hard to get. There are not a lot of lenders who do them, and the process can be a little bit frustrating. So it's an option that I want to make you aware of, but just keep in mind that's not going to be the easiest to go through compared to just a traditional USDA. Here's a couple experiences that people have gone through with USDA, and these are comments from last year's video that I made on USDA loan requirements. So Diana said that she was able to buy exactly what she wanted with zero down, and you could pause this and read it if you'd like. And then also had to bring $1,475 to closing, and that's just of the closing costs. And I'm going to talk about closing costs in this video as well. So what is USDA? Obviously stands for United States Department of Agriculture, and it's a loan for rural areas, but it's a primary residence loan. So if you're looking to buy your first home to live in, or maybe it's a second home that it's not a second home, a second residence, but maybe it's a second time you purchased a home, and it's for rural areas. Has nothing to do with meat, even though this is the USDA. It is a type of government-backed loan offered by many different lenders. You don't go directly through USDA for a USDA guaranteed loan. You go through a lender who then works with USDA. Also, a loan approval through USDA is based on a software called GUS. GUS, it's the Guaranteed Underwriting System. And basically what this is doing is it's taking all of the information about you and the loan you're getting. So what income do you have? How long have you been employed? What's your credit score? How much is the home worth? This software then is going to give you an approval or what's called a refer, which is basically the thumbs down version of this underwriting software. So GUS is what's being used here. A loan officer is going to take your information, put it into GUS, and see if you have an approval or not. If you're not able to get an approval through GUS, there are options called manual underwriting to be able to get approved. And I will talk about that as well. So again, this is going to be super in-depth as we go through this. But a quick side note is navigating this process can be frustrating, and often it's really helpful to assemble a team of really helpful people around you. So if you're looking to build that team and you'd like a referral from me, for someone that I trust, you can talk with a helpful loan officer or a helpful real estate agent, or both if you'd like to. I have links in the description. For a loan officer, you can go to winthehouseyoulove.com/lender. And for a real estate agent, you can go to winthehouseyoulove.com/agent. We have a network of fantastic loan officers and fantastic agents who would be happy to help you take the next step and help you avoid some of the confusion of going at this alone. Okay, so Now let's talk about some COVID changes. COVID threw a wrench in all kinds of mortgage lending and home buying. So I want to make sure that you're aware of this as we're in the middle of 2022. So credit overlays used to exist where USDA technically has a minimum credit score of 500, which I will discuss more in depth about the credit scores. Often lenders were putting what's called an overlay. Basically, it's an artificial rule to help protect them. And they're raising the credit score up to 640 and 680. Some lenders are still doing down to 500, but this is on a lender by lender basis. If you find a lender who isn't offering the bare minimum USDA requirements, then you can always keep shopping to find one that works for you. So credit overlays are disappearing. This is allowing more access to these loans. Also, with COVID, there's been a flexibility for exterior only or desktop appraisals. So instead of it being an appraiser going and doing an interior inspection of the home and an exterior, there is the option for just exterior or just a desktop appraisal, which is basically, think of it like a software version of an appraisal. So USDA states if an appraiser is unable to personally inspect the subject property, the home you're buying, by either interior or exterior means due to either state or local emergency health orders, then they can use an exterior only or a desktop appraisal. One other interesting change because of COVID is starting in May 2nd of 2022 to May 2nd of 23, non-US citizens with a valid social security number and work authorization are eligible to get a USDA loan. Until this 1 year gap, this wasn't, or non-US citizens were not eligible. Okay, first let's talk about the down payment. Of course, we talked about this. Zero. And there is no catch to this. It is 0% down. If you're buying a home that is $300,000 with USDA, you will get a loan amount for $300,000. There is mortgage insurance that's going to be added to the loan that I will talk about in an upcoming slide. But your base loan amount, it's going to be the same as your purchase price. Okay. Now, with USDA, they do have this one weird stipulation that usually doesn't trip up most people. But basically, they say you can't get a USDA loan if you're able to get a conventional loan, right? If you have hundreds of thousands of dollars in your bank account, they don't want you to have access to the 0% down. So what they say in the rules for USDA is they say you must not have the liquid funds, okay? Not retirement accounts, liquid funds to put 20% down plus closing costs on a 30-year conventional loan. So if the home you're looking at is $300,000, 20% down is $60,000. If you have less than $60,000, plus they're going to estimate closing costs. So let's say $70,000. If you have less than that, then you would be able to move forward with a USDA loan and explore if you can qualify for the rest. If you have, and I'm sorry, I meant to say less than that. If you have more than that amount, then you may run into an issue where they look at you and say you actually can qualify for 20% down on a conventional loan, and so you likely won't be able to move forward with a USDA loan. Okay, closing costs. Now this trips up people a lot. USDA, even though it is 0% down, there are still closing costs. When you're buying a home, you have your down payment plus your closing costs, and that equals the total amount that's going to be due at the closing table. So even though the down payment is zero, you do still have closing costs, and they're very similar to other loans. You're going to have an appraisal, you're going to have a credit report fee most likely, you're going to have title fees to do a title search and insurance, you're going to have recording fees, potentially transfer taxes, you're also going to have homeowners insurance, property taxes, and a few other things in there. So keep that in mind that you still will need money to bring to the closing table, although sometimes people can bring zero to the closing table. It really just depends on how your offer is constructed. Okay, so closing costs still exist even if you put 0% down. There is a 1% guarantee fee, and I'll talk about this in the mortgage insurance slide. USDA charges an upfront mortgage insurance, and it's added to your loan amount. It's financed. I'll talk about that more later. You cannot waive escrows. So when you get a USDA loan, they're going to set up a side account for you. It's still going to be your money. They're just going to hold it in there. And it's going to be for property taxes and homeowners insurance. And basically why they do this is because often your homeowners insurance bill is due annually. And your property taxes, at least in Ohio, are semi-annually. So a lot of people can run into the point where they get maybe an insurance bill for $1,500 and they don't have the money for it. So instead, you pay the mortgage company monthly. They set aside your insurance and tax money in a separate account, and they will pay your insurance taxes from that account. The only downside to this is it's part of your closing costs. They need a few months of taxes and a few months of insurance in the account when you close. So that is part of closing costs. You cannot waive that when normally you can in something like a conventional loan. You can get seller credits. So when you negotiate in your purchase contract with your realtor, you can ask the seller to pay a portion of the purchase price towards your closing costs. So for instance, you might go to the seller, let's say you're buying a $300,000 home, and say, I'd like you to give me 1% seller concession. They would then give you $3,000 at the closing table to help offset your closing costs. Also, tax proration is a thing that can help. This is basically where the seller will give you a credit for the taxes of the time that they lived in the property. So for instance, let's say you just bought the home, you're gonna have a tax bill that's gonna come due. And at least in Ohio, since it's paid semi-annually, that tax bill will be for 6 months. Now, you may have only lived in the home for 1 month. So why are you paying 6 months? Well, what ends up happening is you pay the upcoming bill. You lived in the home for 1 month, so you're only responsible for 1 month of taxes. So at closing, the seller will pay you 5 months worth of tax credit to you for that upcoming bill. Okay, so that is something that can help offset the costs. I've done USDA loans with people where they have brought literally $0 to the table. I've also done USDA loans where people have brought a few thousand to the table. So it really depends on how you set up your offer with your realtor and weighing what you ultimately are looking for. So proof of funds, you do need to show USDA where you got your money from, okay? Unfortunately, this is one of the most annoying parts of getting a mortgage is the verification of money. It's a lot of things since the Patriot Act after 9/11, where they're checking for money laundering and terrorist activity and all that kind of stuff. And they want to make sure you didn't just borrow money to buy this house because they see that as risky. So you need to prove where you got your money. They do that through 2 months of bank statements or something like a 401k loan or a secured loan. You can get a gift from anyone that doesn't have an interest in the property, like the seller, the builder, the agent, the lender. So you could get a gift from a parent, from a cousin, if you'd like to, that can help you pay those closing costs. You cannot have an unsecured loan. So you can't go get a credit card, cash advance. You cannot get a personal loan to pay your closing costs. Also, you cannot use cash on hand. You can't just show up and say, I have $6,000 in cash. You can't do that, unfortunately. If you have cash and you need to use it to purchase a home, you're going to have to put that into your bank account and let it what we call season. So basically let it sit in there for over 2 months to be able to then use it for your loan. Also, an underwriter is going to check for large deposits. This is one of those things that they check for money laundering. So basically, anytime they see a large deposit and they say a non-earnings related deposit may need to be sourced. Super vague because it is. It's up to the underwriter's discretion. Basically, if they're looking at your bank statement when you send those into them and they see, oh, you got a random deposit for $5,000 in here. Where did that come from? Did you get cash from somebody? Did you get a personal loan? They need to see where it came from. And so this can be a little frustrating because it is completely up to the underwriter's discretion. If it's payroll related, then that's no problem at all, right? They'll see that as payroll. So just be prepared for that. This often happens where someone has cash and they throw it into their bank account and think they can use it. Unfortunately, that's not possible on USDA. With your credit score, most people have 3 credit scores. You have one from Equifax, Experian, and TransUnion. Okay, and so you'll have different scores with each of them. USDA, like a lot of other loans, is going to use your median score. So in this instance, they would use 636. That is the middle score. They're going to act like the other two don't exist and use the 636. Now, the very bare minimum USDA credit score is a 500 credit score. However, if you have a 640, the doors open up. Anything below 640 becomes really difficult with USDA. There absolutely are lenders who will give you a USDA loan below a 640 credit score. However, there are far more that will give you a USDA loan above a 640. And the reason for that is we talked about GUS earlier. 640 is the minimum credit score you need to get a USDA loan with a GUS approval. All right. So it's a lot easier if they can put your information in and the computer software says, this looks good to us, and you're approved for the loan. If you're below a 640, you can't use GUS. Instead, an underwriter has to manually review your loan. This takes more time, more paperwork, and can often have a slightly increased rate as well. All right, so the minimum is 500, still 0% down. I've done USDA loans, I've done VA loans, I've done FHA loans, all the way down to a 500 credit score. It absolutely is possible, but the world becomes so much easier if you have a 640 and above. Okay, so less than 640 can limit your ability as well. It can shrink how much you get approved for. And just be careful, really quickly, of lenders who might direct you to other programs. Unfortunately, there are a lot of loan officers who aren't familiar with USDA. I'm very familiar with USDA because I live in an area that has a small metro, but then is surrounded by a lot of USDA eligible areas. And so it's very common where I live. But there are a lot of lenders, because they're not familiar with it, they'll like direct you into another program. You know, you might have a 580 credit score and they're like, oh, maybe we go FHA. When in reality, you could qualify with USDA if that loan officer was more versed in USDA. So talk to multiple lenders if you don't hear what you like the first time, and ask for explanations. Hey, can you tell me why I didn't get approved, or why you're recommending another loan? Okay, so for credit events here, anything that's a deed in lieu, foreclosure, or short sale, you're going to have to wait 3 years from that transfer to be able to qualify USDA. If you had a Chapter 7, you're also going to have 3 years waiting period as well. If you had a Chapter 13, you need to be 12 months into an on-time payout, and you need court permission as well to get a USDA loan. This is supposed to say IRS. If you have an IRS lien, then you need 3 on-time payments on a payment plan. And then also for any mortgage lates, if you currently have a mortgage, which most people don't getting a USDA loan, but if you already have a mortgage, you can't have more than 1 30-day late in the past 12 months. Okay. Interest rates. If you want to look at the average interest rates for USDA, you can go to whenthehouseyoulove.com/rates. I have all the rates there, national averages for all different kinds of loans. Usually, USDA rates are lower than conventional and usually comparable to FHA loans. Now, even though the rate is lower than conventional, USDA does have mortgage insurance that stays on for the life of the loan, and I do have a mortgage insurance slide. We'll talk about that here in a second. Brokers often have better rates, so that might be a consideration when you're shopping for different lenders. You can get one interest rate that a loan officer tells you, and it costs $0. That's just the rate they're offering. Now, you can increase the interest rate and actually receive a credit towards your closing costs. And the opposite is true. You could decrease the interest rate and increase your closing costs by basically prepaying interest. So it works both ways. The main reason I say this is because if you're getting a USDA loan, you likely want to bring the least amount of money to closing as possible. So that is an option that you can do. Keep in mind, increasing the rate will increase the amount that you pay in interest over the life of the loan. So just something to keep in mind there. Mortgage insurance. Okay, so if you do get a USDA loan, you will have 2 types of mortgage insurance on your USDA loan. First, there's a upfront guarantee fee wrapped into the loan. This is 1%. You also have what's called an annual fee, but it's paid monthly. And this is 0.35% of the loan amount. This is collected monthly. It lowers each year, but it will never fall off. Okay. Even if you hit 20% equity in your home, it will not fall off unless you refinance into a conventional loan and you have more than 20% equity. Okay. So you have to refinance out of the USDA loan to get rid of mortgage insurance. So here's how this works. Let's say you get a $300,000 loan. So this is the same thing as buying a $300,000 house. 0% down means you have a $300,000 loan. Now, that's the base loan amount. USDA is going to charge 1%. So that's $3,000. So your new loan balance is $303,000. Here's the weird thing about USDA loans. You bought the home for $300,000. You have a loan for $303,000. Your loan amount is higher than your purchase price. So if you're wanting to buy a home for a short amount of time, keep that in mind, because you have a higher loan balance. If you sold the day after you bought your home, you would have to bring money to the closing table to sell your home to pay off the higher loan balance. So do keep that in mind. With USDA, I would err on the side of expecting to stay in your home for around 7 years. Okay. Anything shorter than that you're planning on, I might recommend staying away from this loan because you might not have enough equity to sell without bringing money to the closing table. So that is your upfront fee wrapped in your loan balance. For the annual fee, which is paid monthly, so we think of it like mortgage insurance, even though it's our private mortgage insurance, unlike a conventional loan, it's not exactly that. They call it an annual fee, but it functions the same way. So this is 0.35% of the loan amount, which would be $88.36. The way I got there was taking the loan amount times 0.0035, dividing it by 12. And often people have questions about what is mortgage insurance? Why do I care about it? Mortgage insurance exists to protect the lender in case you don't pay back the loan. It is only an insurance for the lender. It is required. There's no way around it on a USDA loan. It does not benefit you at all, but it is one of the things required with USDA. You get 0% down and a low rate, and in return, they get the mortgage insurance, okay? That's what funds the USDA program. It helps them give out more loans. So it's one of those pro, cons, weigh the good and bad of these different loans. Property requirements. There are way more rural areas than you think, okay? So what you can do is you can Google USDA property eligibility. It's gonna take you to this website. You just click this little disclaimer, and we're going to zoom in. I'm gonna zoom in on my location. So I live in Dayton, Ohio. So here we go, Dayton. Now everything in orange is ineligible for USDA. That means everything out here that's not orange is eligible. This will work for USDA. Fantastic. So let's say I wanted to buy a home in Dayton, or let's say I want to live near Dayton. Unfortunately, all this area does not qualify for USDA. However, I can look at buying a home in an area right here, like Tip City. Tip City, the entirety of this qualifies for USDA 0% down. Now, I know that Tip City and Dayton are only about 15 minutes from each other. So if I had a job downtown, if I extended my commute to 15 minutes, as much as I'd like to live downtown, maybe I really need the 0% down. So that's an option. There are so many areas that are like this, where the metro's not going to qualify for USDA, but the surrounding areas will, okay? And maybe you don't want to live there, and that's perfectly okay. There are a ton of loan options that still work downtown in these areas. But if you want the 0% down, this is what's needed to get that kind of loan, okay? Also, it has to be a primary residence, okay? You can't use this as an investment property. You can sell it anytime you want, okay? So you can buy and sell the next day if you'd like to. No consequences there. However, if you want to rent out your home in the future, you have to live in it for 1 year. So you can't live in the home for 6 months and then rent it out. If you're going to do that, you have to refinance it into an investment loan. However, if you live in the home for 12 months and then you're like, I think I'm ready to buy another house, you can rent out that home without refinancing. All right. You cannot have any income producing land or buildings. So no big farms. Even though this is a rural loan, it's not a farm loan. Okay. Even though it's a rural loan, you can't have cattle, you can't have any sort of livestock, you can't have crops. Okay. No income producing land. If you work from home, that's fine. All right. What they're mainly saying here is as the primary purpose. If there's a huge farm, the primary purpose of that land is a farm. If you happen to have acreage and you have a small business selling soap at home, that's not the primary usage of the land. That will work as long as you're not running full on, huge business operations out of this place and building, a factory. Okay. If you have a home business, that is okay with USDA. There's also no acreage maximum. However, what you do buy has to be a home. This is not a land loan. Okay, you can't just buy land with this unless you're using a construction USDA one-time close loan. No acreage maximum here. So when you get a USDA loan, you're going to have an appraisal, and basically an appraiser is going to come out and they're going to say that $300,000 home that you're buying, is it worth $300,000? Right? They're going to give you money for it, so they need to make sure it's worth that. So one of the interesting things about USDA is that if your appraisal value comes in higher than your purchase price, you can actually wrap your closing costs into the loan amount. So for instance, let's say we're buying a $300,000 home, and let's say the appraisal comes in at $310,000. So you're basically buying your home at a nice discount. If that's the case, and let's say your closing costs are $5,000, your loan amount, you can actually wrap that in. So you could take out a base loan for $305,000, and then you'd also have the 1% guarantee fee on top of that. USDA is concerned with what they call health and safety, structural soundness, and protecting the property value. The best way to think of this is something that's move-in ready. It's stricter than a conventional loan because it is government insured. Okay. So here's some big issues on USDA: broken glass, chipping paint, plumbing issues, exposed wiring, broken HVAC, rotting wood, and a wet basement or crawl space. These will need to be adjusted before you can get a USDA loan. Again, think move-in ready. It doesn't have to be super pretty and renovated. It just can't be a fixer-upper, all right? So I want to show some sample homes because every once in a while, sometimes we can hear about these programs and think, okay, but is that actually true? What do these numbers look like? And so I'd like to go and see what homes were listed at the time of making this video and show you what some of the numbers would look like. So this is a home in Tip City, like I talked about earlier with the eligibility map. And this home is listed for $299,000. It's a 4-bed, 3-bath, about 2,600 square feet, 0% down, so $0 down payment. Closing costs, I'm just using a rough estimate, probably somewhere around $7,500. Principal and interest payment for your loan would be $1,734. The mortgage insurance would be around $87. Taxes, $203. Homeowners insurance, $111, and no HOA. So that would bring the total of this $300,000 home to about $2,135 per month. This is just based on averages. This is not a quote. Okay, please keep that in mind. So this is a nice little home, $300,000 for around $2,100 per month. Of course, you're still going to have utilities and things like that. But this is what the mortgage payment might look like with USDA. Here's another one as an example. This is in Manor, Texas. This is just shy of $400,000, 3-bed, 2-bath. Roughly 1,700 square feet. Okay, really nice home. 0% down. Again, closing costs, I'm going to estimate these closer to $10,000. Principal and interest payment, $2,314. Mortgage insurance would be $116. Taxes, $416 per month. Homeowners insurance, $148. And then there is a small HOA of $30 per month on this. This would bring your total monthly payment to around $3,000 here with a USDA loan. Now, USDA does have, USDA does not have loan limits. Instead of loan limits, they have kind of a little tricky thing here. So no limit loan limits. They do have, though, an income limit that basically functions as a loan limit. So because there is a loan limit, it limits how big of a mortgage you can get, right? So even though in theory there's no loan limit and you could technically get $1 million mortgage with USDA, your income would have to be too high to qualify for that home. So it kind of functions as a loan limit in a weird way. Now, one weird quirk about the income limit is that even if just you are applying for the USDA loan, they're actually going to look at all household income for adults 18 or over. So even if just you are on the loan, if your spouse or your partner or you have a child over 18 who makes money, that will be factored into the income limit, something to be aware of. USDA guaranteed, they say, is for moderate income individuals and can extend down to low income. And they base the income limit on 115% of the area median income. And this is based then on family size. So I want to show you a tool of how you can figure this out for yourself. Again, same link. You can just Google USDA property eligibility. On this same page, I'm just going to click income eligibility. And we have to kind of go through a quick little questionnaire because it is conditional based on your location, family size. So I'm just going to choose a random county here in Ohio. Number of people in the household, for simplicity's sake, I'm just going to say 1. And so we can see number of residents under 18. It's going to ask us a few questions here about anyone disabled or anybody 62 or older who will be not included in the income calculation. So just for this example, what they're offering here is like they're saying like put in your income and they'll tell you if you qualify or not. I'm going to put in a fake income of $5,000 a month. Click finish. And so we can see the guaranteed housing loan program maximum adjusted household income is $103,500. So if you're below that, right, household, keep that in mind, household, then you can qualify for USDA. If you're below that. If you're above that, you will not be able to qualify for USDA. And please keep in mind, this is household income, even if those people are not on the loan. So that brings us to income and employment. USDA does expect stable income and employment and looks for a 1 to 2 year job history. Okay, it doesn't have to be at one particular job. They prefer to see 2 years history, but 1 year can often be acceptable. There is no minimum for a particular position. All right, keep that in mind. It's not 2 years at one job, just a 2 year history. They want to see consistency of your income and employment, even if you work multiple jobs over that 2 year period. Retirement is an acceptable kind of employment. So if you get a pension, Social Security, things like that, that is your employment history. Non-taxable income, so things like Social Security benefits, they can be grossed up because lenders work on gross income. So let's say you make $60,000 per year. Well, you only probably net take home maybe somewhere around $45,000, but the lenders use $60,000 for how much you can afford based on their risk. So non-taxable income, they have to kind of add a padding to it as if taxes were on it. So the way you do that is you take your amount times 1.25. And so you'd be able to qualify with that $2,000 tax-free income as if it were $25,000 taxable income. All right. Self-employment minimum is 2 years. You need to have a minimum working self-employed for 2 years. College does count. Having an education does count towards your employment history there. Okay. So affordability. USDA, like a lot of other loans, uses an affordability metric called the debt to income ratio. And so there is what is called a front end and a back end. The front end is your future mortgage payment divided by your gross monthly income. The back end is your future monthly payment plus any monthly debts you have. So things like car loans, student loans, personal loans, credit cards. It does not include groceries, gas, other expenses that are not debts. So the back end is your future mortgage payment plus your monthly debts divided by your monthly gross income. If you are in a community property state, and you can Google that, am I in a community property state? You must include your non-purchasing spouse's debts. So if you're buying a home, but your spouse is not going to be on the loan and you're in a community property state, you will need to include their debts in that consideration. If you want their income as well, you also have to consider their credit score and add them to the loan. Now, if you want to figure this out, I do have a calculator called the max purchase price. The link is in the description. You can plug in some numbers and just see an idea of what you could afford based on the debt to income ratios. So here is GUS versus manual underwriting. We've talked about GUS already. So the ratio maximum for the front end is 33.99 and the back end is 45.99. Now, two caveats here. Just because you could get approved by a lender for a mortgage at a certain amount in payment doesn't mean it's financially smart for you to do that. The lender is only worried about the risk of you paying back the loan. They do not care about your personal financial situation. They are not your personal financial advisor. So please keep that in mind. All right. Also, these are not published things, right? USDA didn't come out and say, here is what the ratios are. Here's what the maximums are. These are what people have found through GUS, through testing a bunch of different loans what it looks like the maximums are. All right. This is the maximum that people have seen get approved. So for example, let's say we're looking at a $70,000 per year gross income. All right. The front end would be $1,983 per month. That means that's the maximum mortgage payment you could get with that income. All right. The back end would allow you $700 per month. If we maxed out our mortgage payment to this, it would allow you an additional $700 per month in something like car loans, student loans, credit cards, personal loans. Now, with manual underwriting, anything less than a 640 credit score is going to reduce your affordability, right? I talked about that earlier. It reduces those ratios. So the front end gets reduced to 29% and the back end gets reduced to 41%. Now, keep in mind that just because we're seeing these here doesn't mean that it will automatically work that way for you, right? To get all the way to the maximum of these ratios, you need to have a really high credit score. If you have just like a 641, you may not be able to go all the way up to a 33.99% on the front end. Gus may limit the amount that you can afford. All right. So these are more flexible, and unfortunately, there's no way to tell you exactly what they are because they're not published. So it's something that you have to talk with a lender to see if you can qualify. Okay. So in this same example, $70,000 a year income, it would be $1,692 per month. And then this would also offer you $700 in room for extra debt payments. Now, if your debts are above $700 per month, that will eat into this number here and reduce that number. Okay. USDA also has what they call ratio waivers that allow you to have up to a 32% front end and a 44% back end. And these require compensating factors, which I will talk about here in the future. Student loans. Okay. So people sometimes think that with student loans, they can't qualify for a mortgage. You absolutely can. Tons of people can qualify for a mortgage, even if they have student loans. Now, USDA looks at a program called CAIVRS. And basically what CAIVRS is it's a list that the government has where if anybody has defaulted on federal debt, like a federal student loan, then you get put on this list called a CAIVRS. And then anytime you try to get another government loan, like a USDA one, they're going to check the list and see, well, if you didn't pay back the federal student loan, why would we give you more money? And so if you're on CAIVRS, you can't get qualified for a USDA loan. However, there has been a recent ruling with student loans where CAIVRS or loans that have been what are called delinquent have been lifted out of delinquency. And so check with the Department of Education to see the status of your student loan. Income-driven repayment is allowed on a USDA loan. So the rule is if the payment is $0 per month or deferred, then you must use 0.5% of the balance included in the debt to income ratio. Okay. However, if you're on income driven repayment and your payment is $100 per month, then you can use that, right? If your normal student loan payment would have been $500 per month, but you're on income driven repayment, it's only $100, you can use the $100. But if your income driven repayment is $0 per month, then you have to use 0.5% of your student loan balance. It's frustrating and annoying. I know. So for example, $50,000 student loan balance would be $250 per month based on 0.5% of the balance. Okay. Manual underwriting. So the ideal situation is your loan goes through GUS and you get that approval. However, if your loan gets put through GUS and you get kind of the thumbs down, you have to do what's called manual underwriting, where a underwriter is going to take a little more of a detailed look at your loan file. If you have less than a 680 credit score, then your ratios are maxed to that 2941 that we talked about earlier. If you have greater than a 680, it can go up to 3244 as long as you have one of the following. Either the mortgage payment, principal, interest, taxes, insurance, is the same or less than the current housing payment, so what you currently pay in rent or a mortgage, or you have 3 months of reserves of your future mortgage payment, or you've been with your current employer for 2+ years. Okay, seller credits. We talked about this earlier. This is where you can negotiate for the seller to pay a portion of the purchase price towards your closing costs. Now you can do up to 6%. So If you're looking at buying a home, you can go up to 6. You cannot ask for more than 6% of the purchase price towards closing costs. Usually 6 is more than plenty to cover all your closing costs. Now, keep in mind, seller credits can make your offer less attractive. You're basically asking the seller to cut into the amount that they would be able to profit from their home. So often what can happen is you can negotiate your purchase price to be higher to compensate for the seller credits that you may be asking for. So for instance, let's say you're looking at purchasing a home that's $300,000, down payment's 0. Let's say closing costs are $6,500. And you ask the seller, hey, we're going to buy for $350,000. Could you give us 1% back as a credit? So $3,500 here, $6,500 minus $3,500 is $3,000. This is what you would bring to the closing table. Sometimes, and talk with your realtor about this, you might be able to say, maybe the seller says, we don't want to do that. I don't want to give you an extra, I don't want to give you $3,500. You could negotiate to increase your purchase price and say, okay, we'll offer $353,500. Could you give us 1% back? And the math works out to be very close to this number. Okay, so some special requirements, features that don't fit into some of these buckets. USDA is a little weird, and it has what's called a conditional commitment. So normally what happens with a loan is you get pre-approved with a loan officer. Then when you find a home, your loan officer takes all the information that you gave them and then sends it to an underwriter. An underwriter gives you what's called a conditional approval. Then you have an appraisal done and maybe a couple extra documents. Then you have a clear to close, meaning the loan is completely done, you're in the clear, and you're ready to close on the home. USDA is a little bit different in that an underwriter packages up the whole thing and they make sure all the boxes are checked and everything looks good. And then they're actually going to send it out to USDA to review. So there's basically an audit done by USDA on your loan file. And this really can change how long it takes based on where you're at and how busy everybody is. So usually I would say this is probably going to be around anywhere from 2 days to 7 days. Check with your loan officer on current USDA turn times in your area. But what happens is your underwriter is going to send this to USDA. USDA is going to look it over. They're basically going to look at it a second time and then issue a conditional commitment. Okay. The wording of that doesn't really matter. They give it back to the underwriter. The underwriter then will give you a clear to close. So just keep that in mind. USDA loans often will take a little bit longer of a time to close than something like a conventional loan or even an FHA loan. Also, there are the one-time construction loans that I mentioned at the beginning. They are hard to find though. There's a rehab option for up to $35,000 in non-structural repairs. And then also you can get more if you need structural repairs. Same thing with the one-time close though. These can be difficult to find lenders who offer those programs. You also can get a USDA loan if you have no credit score. Low credit score is different than no credit score, right? If you have a 400 credit score, you won't be able to get a USDA loan. If you have no credit score, you can get a USDA loan through what's called non-traditional credit. And so basically they're looking for what are called trade lines. Think of it like if you had a credit report, you would have a student loan, a car payment, and a credit card. Those would be 3 trade lines. They're basically saying if you don't have any of those things, we need to see that you have payment history on time with accounts that you have. So often this is used with something like a verification of rent. So they'll look at 12 months of on-time rent payments, things like history of utility payments, or things like insurance, leases, internet, phone bill, things like that, to just see, have you been paying things on time? They want to see a history that you have, and they'll use that as non-traditional credit if you have no credit score. And then for refinancing, okay, so you can get a USDA loan, and then you can actually refinance that USDA loan to get a lower interest rate. USDA is interesting that they have more streamlined options. So they have what's called streamlined and streamlined assist. On both options, your rate cannot increase. Okay. Sometimes people will refinance a higher rate because they'll pull cash out or they'll do something, more interesting with rearranging their debts around. On USDA, your rate cannot increase. Also, it has to be a 30-year fixed refinance. And something to keep in mind is there are no cash out options like there are on other refinances. So here's a comparison, streamlined versus streamlined assist. You do have to wait 12 months since you first got your USDA loan. There is no appraisal on either of these. For credit, on the Streamlined Assist, you do not have to have your credit pulled. On a Streamlined, you do. Debt to income is checked on Streamlined and not on Streamlined Assist. NTB, that's a net tangible benefit. On Streamlined, you do not have to prove a net tangible benefit. On Streamlined Assist, your payment has to be $50 less per month. And on Streamlined, you can remove borrowers. On Streamlined Assist, you can only remove deceased borrowers, okay? You can add a borrower on both. I know this can be confusing. You can talk with a loan officer to explore your USDA options. So basically, if your score increased, this could get you a better rate. This is what mainly this kind of comes down to, is if you get a USDA loan, and let's say you had like a 580 credit score, and then maybe 2 years later, your score increased and you want to get a better rate, Streamlined is the way that you're going to do that because they'll pull credit. If you go with Streamlined Assist, they won't be able to use your improved credit score to qualify for the loan. Okay. Now, you absolutely can refinance into another loan type like a conventional loan. This would often be done, let's say you build up enough equity, let's say more than 20% equity, refinance to a conventional loan to then remove the mortgage insurance from your USDA loan. Otherwise, you will pay USDA mortgage insurance for the entire life of the loan until it's fully paid off. So success rate, seller perception. If you're going to use a USDA loan, how is a seller going to view you? Because when you're buying a home, you're going to be competing against other buyers most likely. And some buyers have financing that can be perceived as better than other types of financing. USDA is way less common than conventional FHA, and I would argue VA. Now, a good real estate agent that's working on your behalf can help explain to the seller more about USDA loans. This can help ease some of the maybe tension around the mystery of USDA because it is a fantastic loan program. Now, USDA can often be slow because of the USDA conditional commitment. There was a time when the conditional commitments were taking like closer to 10 to 14 days. They're not like that currently at the moment. But when that was happening, that puts me in a very awful situation to have to explain to my borrowers or the listing agent why the loan is taking longer than usual. Those are things out of your loan officer's control, but they are something to be aware of. Also, the appraisal can be perceived as a pain because it's a government loan. It's going to want the home to be in better condition than something like a conventional loan. So if a seller is looking at your offer and they say it has a USDA loan and someone else has a conventional loan, you want to talk with your realtor about how can you make sure that your offer compensates for the fact that USDA could be perceived as a little less than ideal to the seller. So in really heavy sellers markets that are competitive and you're competing against a lot of buyers, USDA is not going to be a really strong hand to play. Conventional is better in that option. If we're in a buyer's market and you have more of the control and the sellers don't have as many options, then USDA can be a really good option for you. Okay. Now, ultimately, how do you get one? Really, it's not super difficult to start this process. You're simply just going to reach out to a lender, say, hey, do you offer USDA loans? Have you done USDA loans? And then apply with that lender to get pre-approved. If you would like to talk with a helpful professional, either a real estate agent or a loan officer who can walk you through some of the guidelines and help you purchase with a USDA loan, I do have links in the description. As always, thank you so much for watching.